Bring in show music, please.
This is Squawk Pod, and I'm CNBC producer Cameron Costa. On today's episode, a trade deal with the UK, a potential trade deal with India, and trade talks with China starting this weekend in Switzerland. Michelle Caruso-Cabrera fresh off her trip to China on the trade war de-escalation in progress.
I'm not predicting their collapse. It's just when it comes to leverage, I think we have more. They have an economy that has been reliant on investing in real estate and exports.
And buy now, pay later company Affirm has a unique view of the consumer's pocketbook, what CEO Max Levchin sees in the spending economy.
There is a real inconsistency in the vibe where people are stressed out about the economy, yet they're shopping, they're buying, and they're paying their bills. At least they're paying their bills back to us on time.
Plus, the Trump administration is considering raising taxes on top earners to pay for the GOP tax package. But Emily Wilkins reports it's complicated.
Previously, they cast doubt on this idea. They didn't think it was viable. But right now, lawmakers really need to find revenue raisers.
It's Friday, May 9th, and Squawk Pod begins right now.
Stand Becky by in 3, 2, 1. Cue, please.
Good morning, everybody. Welcome to Squawk Box right here on CNBC. We're live from the NASDAQ market site in Times Square. I'm Becky Quick, along with Joe Kernen and Andrew Ross Sorkin.
Reuters reporting that India has now offered to slash its tariff gap with the U.S. to under 4% from nearly 13% under a potential trade deal. The report says that India is asking the Trump administration for an exemption from all current and future tariffs, and it's ready to give preferential access to 90% of U.S. goods. So potentially, maybe there is some deal to be had. We will see.
You know, that preferential treatment, that sounds like the same thing that the UK deal is kind of laying out to cut through the bureaucratic red tape and open things up more quickly, too.
Didn't do anything on beef.
No.
Or chicken that's
those
washed
are some big issues. Those are some big issues overseas.
It's been mad cow for a while, I think.
It was mad cow, but then there are issues in the EU where they won't allow hormones or different things that have gone through.
Chlorine-washed chicken, even though no one...
Yeah.
Meantime, let's tell you about the UK trade deal, because President Trump unveiling the broad outlines of that trade deal with the United Kingdom. A fact sheet released by the White House saying that the deal will create a $5 billion opportunity, they say, for new exports for U.S. farmers and other producers. They'll adjust tariffs on British cars and commit both countries to working together, they say, to enhance industrial and agricultural market access. 10% blanket U.S. tariff on the UK imports will remain, though. President Trump saying more details will follow in the next few weeks. U.S. Trade Representative Jameson Greer spoke to Power Lunch yesterday about that agreement.
What does this mean for other countries? Is this a framework? This certainly is the framework. I've been talking to dozens of countries, and I tell them this. I walk through different buckets where we need to talk about tariffs, non-tariff barriers, economic security, etc. And this is the right framework, and other countries should look to this as a model.
Should mention some negative reaction to the deal from U.S. automakers. In a statement, the American Automotive Policy Council saying the following, the saying, quote, "We are disappointed that the administration prioritized the UK ahead of our North American partners. Under this deal, it will now be cheaper to import a UK vehicle with very little U.S. content than a USMCA compliant vehicle from Mexico or Canada that is half American parts." So there's still a lot of confusion about some of this, but I think even more importantly, this idea that there's effectively going to be a 10% tariff on everything coming into this country going forward, no matter who you are. That seems to be the...
I think that's a big deal, that U.S. automakers who are following USMCA are going to get hit with harder tariffs than a Range Rover or...
Well, that's the only car I could think of.
Coming in.
I mean, unless you can afford an
Bentley.
Aston Martin.
On the China front, investors are awaiting news from this weekend's meeting in Switzerland between Treasury Secretary Scott Bessent and Trade Rep Jameson Greer and their Chinese counterparts. President Trump saying that he expects substantive negotiations and predicted yesterday that 145% U.S. tariffs on China would come down. This morning, Bloomberg is reporting the White House is weighing a dramatic tariff reduction during this weekend's talks, perhaps below 60% as a first step that China could match. New Chinese data today showing that country's exports surged in April thanks to a jump in shipments to Southeast Asian countries. That offset a sharp drop in exports to the United States as new tariffs kicked in. But again, Scott Bessent has been very upfront about how they are looking at this, or he is looking at this as a de-escalation. It's hard to imagine getting there without at least dropping those initial tariffs, both on what we are, the 145% we have and the 125 that they have.
Suppose it's going to 50.
Right, which gets us back to where we were about a month ago.
Right.
But a couple of days ago, President Trump was saying no, he wouldn't lower them at all. It's hard to imagine any progress if that doesn't happen.
It's high stakes. We'd like to get the Treasury Secretary on next week, but it's all up in the air. I know we're trying, but it's all up in the air. Let's see how it goes. I guess what I was thinking was I was watching yesterday, and the president outlined the UK trade deal, and it's, coming from him, it's one thing, but then on the phone, we've got Keir Starmer, and it was a total love fest. Keir Starmer got on, and this is, God, we love the United States. The United States loves us. It's our greatest, one of our greatest trading partners. It's really a great deal for us. Both sides are great. But Keir Starmer needed a win, too. There's sluggish economy in the UK, but it was a total, just watching it was like,
Michelle Caruso-Cabrera just spent 3 weeks in China, and we're going to talk to her about her impressions about the Chinese economy when she comes in just a little bit.
3 weeks in China, one Friday afternoon. Yeah. Oh, no, it's Philadelphia, isn't it?
I don't know.
I think it's Philadelphia. Trump administration now reportedly considering, once again, raising taxes on some of America's highest earners. Emily Wilkins joins us now from Washington. There are some twists to the new proposal, Emily.
There are lots of twists, Joe, and we are following them all. The latest news, yes, is that Trump's ramping up pressure on Congress. He had a call with Speaker Mike Johnson asking him to raise taxes on the highest earners in that upcoming tax package. We have the details of the White House proposal. They're asking for a 39.6% tax rate on individuals making $2.5 million or more. Of course, current rate 37%. The proposal from the White House would also include a carve-out for small business owners who count the income from their business on their personal taxes. And that addressed some concerns that lawmakers had. They did not want small businesses to be penalized by a higher tax rate. Now, GOP leaders in the House, we've discussed this before. Previously, they cast doubt on this idea. They didn't think it was viable. But right now, lawmakers really need to find revenue raisers in order to pay for not just extending that 2017 tax law, but all the other things that Trump wants, like no tax on tips. And this package is going to cost a lot. The Peter G. Peterson Foundation estimated that extending the 2017 law and then giving Trump most of the items he wants could cost more than $9 trillion. And that's one of the middle of the road estimates. We've seen estimates that have gone higher. The top tax writer in the Senate, Senator Mike Crapo, told Hugh Hewitt yesterday that he is actually not a fan of this higher tax proposal, but he notes that other lawmakers in the House and the Senate do support it. And he said if Trump really does weigh in and push this, it's going to have a major impact, in suggesting that there is a path forward to get this into the final bill. Now, Republicans are still fighting over the details of the tax bill. A proposal to raise the SALT cap to $30,000 for both individual and joint filers was shot down last night by 4 House Republicans, all New Yorkers. They said in a statement that the proposal risked derailing the entire bill, calling a higher SALT cap not a luxury, but a matter of fairness, and suggesting they'd vote against a package if they didn't see a higher cap. And of course, these small margins in the House, it means that those 4 lawmakers could sink the bill if there's not a change. We're going to expect to see a few more details soon on the tax package. It's expected to get its first vote in the House next week on the Ways and Means panel. We're expecting that to begin Tuesday, and a lengthy markup expected to go into the night. And that will be the first hurdle that this tax bill is going to clear, but certainly not the last. Guys?
Yeah, I've been against that all along. The carve out for small businesses makes a big difference. The top marginal rate that was cut from 39.6 used to start at what number, Emily? Like much lower than $2.5 million. It was down, and they weren't
much
high,
lower.
Yeah, especially in certain states, they weren't high earners at all. That when it went to 37, so going back to $2.5 million and $5 million for joint filers. It wouldn't be the end of the world necessarily. If you're doing it, does redistribute which segments of Americans are carrying what type of load for taxation. So I can see how you could almost make a case for it. I think Trump is going to go with it. That's what I'm hearing anyway.
Trump is already behind it. The question is, will they get the votes in the House?
Well, he wasn't behind it, but when you go to 2.5 to 5 and then you carve out small businesses, that makes it different. And you're doing all those other. What was interesting, what you said, Emily, was that the 30,000 cap. It's not that they're saying no, we can't. We can't blow out the deficit with more giveaways with the SALT cap. They don't like it because they want the cap is too low.
Yeah.
So they want it actually higher than that, which would be even more costly to make that cap higher.
And this is the balance, Joe. This is the balance they're having to deal with. If they want to do things like a higher SALT cap, if they want to do things like no tax on tips, benefits for seniors, all this other stuff that's been proposed, all of that costs. And they have to, the way that they've structured their framework that got passed the other month, they can't go over a certain limit. They have to find some revenue raisers somewhere.
And carried interest too, right?
Yeah.
That's right now they'll say everything is on the table. I've heard some pushback on carried interest, folks saying it just doesn't go far enough, it doesn't bring in enough revenue. But at this point, I would say it is absolutely still on the table and something that the White House does appear to be pushing for.
Yeah, I read yesterday the White House was behind getting rid of carried interest.
I've had some conversations where it's definitely something. Yeah.
I guess the question is whether it's still going to be enough in terms of raising revenue to appease the deficit hawks.
You're going to have to say growth. You're still going to have to fall back on the growth. It's not a lot.
Are there Republicans who have been deficit hawks who will go along with that to rely on the growth?
It depends on how much you credit the 2017 cut in the rate to the growth that we saw. Was it individuals? Now at least they won't do it to businesses. It's a little better, but George H.W. learned no new taxes. That didn't work for him. Thanks, Emily.
Cheese will be next.
Next on Squawk Pod, buy now, pay later. The payment plan business is alive and well. Groceries, concert tickets, Affirm is gaining traction. CEO Max Levchin, a co-founder of PayPal, says the payment world is still evolving.
Insofar as people become more comfortable with tools that don't look as traditional as the things that work for their parents, yes, I think the secular trend is towards using things like Affirm to replace credit cards.
Welcome back to Squawk Pod from CNBC with Joe Kernen, Becky Quick, and Andrew Ross Sorkin.
Up and Becky, Q.
We've got the latest CNBC SurveyMonkey Small Business Survey out today. It shows that confidence has declined in the quarter, down to 51 points from 56 in the previous quarter. 30% of small business owners describe the economy as good or excellent. That's a drop of about 10%. The views vary sharply, though, by political affiliation. Only 8% of Democrats say the economy's in good shape, compared to 51% last quarter. Optimism among Republican small business owners is up to 52%, and that's a jump of 21 points. So much of this influenced by your political perspective on all of it. Inflation and tariffs are the top concerns for small business owners. 70% believe that the U.S. is headed towards a recession. 59% are worried about the ongoing impact of tariffs on their businesses. And one more note for you. Women small business owners are less optimistic than men about the economy. 21% of the women say that the economy is excellent or good, compared to 34% of men.
Meantime, check out shares of Buy Now, Pay Later, the platform Affirm, moving lower this morning after the company provided, he's sitting right here, so it hurts me to say it, weaker than expected revenue guidance. Joining us right now with more on the quarter and beyond, Affirm CEO Max Levchin. Good morning to you.
Good morning.
Okay, so let's understand what's going on in the last quarter, and then let's try to understand what's going on with the guidance and what you're actually seeing.
Last quarter, judge for yourself, 36% year-over-year volume growth. Revenue growth also 36%. RLTC, which is a fancy term for profit measure that we prefer, 53% growth. It's pretty good.
It's pretty good.
Pretty good. Guide forward, I think really strong numbers. We think we're, going into uncertainty, we are offering our shareholders a sense of we're going to do just fine.
And you think that just the market, to the extent that the market's not even open, but obviously down 6% as we're looking at it in the futures?
I cannot pretend to understand how the market thinks. I can tell you that it took consumers and merchants and sort of the universe about a decade to figure out what we are and just how different and important what we have found to work really is. This whole buy now, pay later thing. 13 years ago, people were telling me not charging late fees is nuts, not compounding interest is crazy. When you say 0%, you're supposed to have an asterisk where there's the fine print, that's where the business model lives, and we said no such thing. And it was slow for a while and not all at once. And my plan or my wish for the market is to eventually oh, wait a second, this is really good.
What is your sense just of the strength of the consumer right now?
It's pretty good. I think there's a real inconsistency in the vibe where people are stressed out about the economy, yet they're shopping, they're buying, and they're paying their bills. At least they're paying their bills back to us on time. Our credit print actually from last quarter, and you can see it every month because a lot of our credit results are reported every month, is really solid, very, very consistent with our expectations, not rising.
That's really interesting. We heard from Bank of America Institute this morning, and they said the same thing based on all the data they see from their customers. Do you think that this is the consumer worrying about things, but they're not changing their behavior at this point? Our guest this morning tied it back to the idea that there's still a very strong jobs market and that wages continue to rise.
That's exactly right. The only metric that I really care about running a credit business is employment. If employment is strong, everything's going to be just fine. And employment has been really strong. The last job print was fantastic from my point of view anyway. And so I don't see anything in the water yet that makes me
Is there any shift in terms of the kind of purchases that people are making, the amount of money that they're spending? Are they are they upgrading from a 75-inch TV to an 85-inch TV, or are they downgrading from an 85-inch TV to a 65-inch? To the extent that that means anything.
We delve into this data every single day, and the short answer is we saw really strong growth across every category. Yesterday, somebody asked me on an earnings call, so where did you see particular strength? And I was scrambling through numbers, everywhere. The number from this morning, I think you quoted 1% increase in credit card and debit card spend, 36% increase in Affirm spend. There's some difference here.
But it's also that you're stealing market share. You're building your customer base.
We are helping people understand that not paying interest, revolving interest excessively is a good thing. And yes, we're taking share from credit cards. But right now, the economy appears to be on solid footing.
Can I ask you it's sort of a crypto-related question of sorts, which is in a stablecoin world or crypto world, how does that ultimately affect you, and what do you think how will that change your business if you think that the world moves in this direction?
You and I have been on stage together talking about crypto a little while ago, and my views remain about the same. I think Bitcoin in particular is a fantastic store of value. I think that's proven to be the case, and today's numbers are one good proof point. Stablecoin has really nailed this exceptional use case of very fast foreign cross-border money transfer, and I think that's very useful. And as a company that's now expanding internationally, we just went live in UK, went live in Canada a little while ago, so it becomes more and more relevant to our business. In terms of folks paying for things, I think we're still very heavily dollar-centric here, and I'm not sure that's going to change.
But will that whole universe ultimately break the banks and put you into a position where all of a sudden you are the credit? You are trying to be the credit card. Right?
We're trying to replace the credit card.
Trying to replace the credit card. But I would assume that would accelerate in a sort of stablecoin-oriented universe.
Insofar as people become more comfortable with tools that don't look as traditional as the things that work for their parents, yes. I think the secular trend is towards using things like Affirm to replace credit cards.
And in terms of merchants and just bringing more merchants on board, the idea of who's exclusive to you, who's not exclusive to you, how that even works. Obviously, Klarna's playing a big role in the universe. I don't know what's going on with Walmart. Maybe you can explain. But I think we're all trying to get a sense of this.
So merchants are also doing quite well. I think a fair number of them are posting really strong results. And part of those results is the fact that the consumer is really choosing Affirm at the point of sale. Done really well. The thing we highlighted actually on the call yesterday and last quarter, merchants are really leaning into 0% promotions where they are essentially paying the interest that consumers would be otherwise paying. And so it's a true, it's a great value. You're paying for something that is quite expensive over time, but not paying any interest on it at all. And even if you are late by a day or miss a payment, you're still not paying any penalties. That was a huge driver of growth for us both last quarter and the one we just reported. Many merchants have reached out to us and said that really worked for us over the holiday season. Let's do it again. That's a fair amount of the growth that we saw comes from that. Certainly not my place to comment on competitors, but we seem to be growing, somewhere between 50% and 100% faster than just about anybody else in the industry. So I think we're doing really well.
Max, who is your customer? What are their demographics? Because I think of like an Amex customer. They've got a pretty high-end customer who doesn't tend to feel the pinch as quickly as a lot of others. But I get the sense that if I'm doing buy now, pay later, maybe it's a customer that's not quite as wealthy. Am I just wrong in thinking that?
I think that's a misconception that it skews lower income, lower credit. It's actually much more middle of the road. Do you imagine sort of a 10 styles of American consumer? We start helping folks that are about a third of the way up the credit and run out of things to say by the last 10 styles. So if you're independently wealthy, you may not care whether you're paying interest or not because you're just settling out of your...
Or maybe you're paying cash for the most part, or using a credit card that you pay off immediately.
Exactly. But vast majority of our consumers are what's called prime, near prime. We actually pointed out that last quarter's growth, a fair amount of it came from prime and super prime because of these 0% promotions. So folks...
So they're getting a bargain at that point.
People, you don't have to be poor or rich to realize that not paying interest over a long period of time is actually pretty great.
Smart, right. Yeah. I guess my question would be, do they get their credit score improved by paying off stuff on time with you too?
Great prompt. So we just announced a couple. So we've always reported credit results on our longer term transactions. So monthly transactions is something that we felt was really important to report to the credit bureaus, exactly to help folks build their credit history and ultimately improve their credit score, so long as, of course, they pay on time. We just expanded that program with Experian and TransUnion, delivering basically all the information we have on consumers about their repayment, precisely because we really care about credit history building.
For those folks who are just thinking about what this company looks like 3 or 5 years from now, in your mind, what is it? Or how does it change beyond just simply growing across the board?
It's going to grow. I feel pretty confident in that. It's a payment network. You will see more Affirm logos, not just on your favorite website, but also on a hopefully convenience store door. It'll be online and offline. It will also be a feature or functionality provider to other debit cards. We have our own debit card that's been growing, better than doubling year over year, really taking off. It's a great product that just very, very happy with. We are now starting to talk to people embedding Affirm in debit cards that are issued by other folks. So you may yet, 3 years from now, have a debit card issued by your bank or your favorite fintech with Affirm functionality embedded in.
Okay, I have one news you can use question. Do you use Affirm?
Absolutely, every single day.
How so?
Buy a cup of coffee with my Affirm debit card. Oh yeah, absolutely. It works both.
And you pay it off when?
So Pay Now settles against my bank account.
Right.
If I take a couple of friends to a really fancy dinner, I sometimes test the functionality of paying for that expensive dinner over time. Anything from 6 weeks to 6 months.
Okay.
But every single day.
Curious. Thanks.
Coming up on Squawk Pod, trade talks between the U.S. and China kick off this weekend, but who has more leverage walking in? We'll hear from CNBC contributor Michelle Caruso-Cabrera.
Remember, in democracies, you have your fights out loud and in public. You don't think the knifing, in the back of other people is happening over there? Of course it's happening in there. It just happens behind closed doors.
You're listening to Squawk Pod.
You're watching Squawk Box right here on CNBC. I'm Andrew Sorkin, along with Joe Kernen and Becky Quick.
Treasury Secretary Scott Bessent and U.S. Trade Representative Jamieson Greer will meet their Chinese counterparts in Switzerland this weekend for trade talks. There is a first sit-down that this will be taking place since President Trump hit 145% tariffs, hit China with 145% tariffs. The president saying that he expects substantive negotiations this weekend. And joining us right now to talk more about it is Michelle Caruso-Cabrera, MCC Global Enterprises CEO and a CNBC contributor. She's just back from nearly 3 weeks in China as part of a Brookings foreign policy delegation. And Michelle, what'd you learn on the ground there? Were you able to get a real view of what people in China think about this?
So a couple of things. First, the economy's weak. There's been deflation. Things are so cheap compared to I think all of you went to China during the heyday. Yeah. Difficult to get a hotel room, everything expensive. That is not the case anymore. The other thing that surprised me was Not one bad word about President Trump. Not from people on the street, not from people in the government. They were very quick to criticize Joe Biden. I think that's because Joe Biden's not in power anymore, so that's easy to do. But I think there's also this expectation that Joe Biden was going to be different on a China policy.
But he kept all of the tariffs in place.
Introduced export controls, right? So they're discovering that the attitude towards China is very bipartisan. But I think,
you mean from the United States having a strong kind of hawkish?
Absolutely.
There's no undercurrent of not liking Xi yet. Is there that we're hearing about?
I got no evidence of that. Nobody referenced.
I'm not blaming him for anything.
You think that they would say that to a Brookings delegation?
No, I know, but no body language,
nothing.
Anything.
No.
Did you think your hotel room was bugged?
I worried about that, sure.
Did you bring a separate burner phone?
Of course I did. I brought separate burner phones and stuff. So by the way, I mean, it's like if you want to go on vacation, it's extremely cheap, okay? Except for the hurdle of having to replace all your technology.
It really looks bad over there, like the economy.
I mean, it's relative, right? So if you went back when the growth was crazy and the cranes were everywhere, things were more expensive, it was harder to get things done, harder to get into hotels and things like that. Now, you're in the beautiful hotel in Beijing and it's very quiet in the lobby, et cetera. There's just less to do there because their economic wounds, remember, are self-inflicted. They're starving the private sector, right? And as a result of starving the private sector, they do overinvestment in real estate, they subsidize exports, which is why their consumers don't have the level of consumption that we would like and would help, balance of payments in the world. So, you see all of that really play out there. Now, because of CNBC, I've traveled to most of the great autocracies in the world, and I would say it's the one that, except for North Korea, for example, that's where you're going to see the far most Gucci, Prada, et cetera. Right. There's commerce there for sure in a way that you don't see in Tehran, that you don't see in Cuba. It's not like that. But no, there's no evidence of discontent, but I didn't expect to find any.
So Chanos used to come on and talk to us about the ghost cities that were there, the buildings that they were
never go over there.
15, 16 years ago.
I wouldn't go, I don't think.
I've said enough things on there.
If you ride the bullet train from Beijing to Shanghai, which I did, which, by the way, compared to Amtrak is a really incredible experience. You see those places, all this massive growth that happened along that corridor that's obviously not being. Now, the other important data point, I mean, there's a reporter there from the FT who's done great work looking at the restructurings there, and especially when it comes to real estate, and the recovery rates on the restructurings that they've done 0.6 cents. I mean, that is horrendous.
So not even pennies on the dollar, less
not
than
even
a penny
pennies on the dollar.
Right.
Okay, and those are restructurings done out of Hong Kong, right? Not out of the mainland. And so they've got issues. Now, they've got capital. I'm not predicting their collapse. It's just when it comes to leverage, I think we have more. They have an economy that has been reliant on investing in real estate and exports. Real estate's done.
That's what they have,
and exports.
But we have to respond to press criticism and the suffering of our people. They don't have to do any of that.
The pride and ego are rather large.
Right. But
we have more leverage, but she doesn't have to be reelected.
That is his one point of leverage. He doesn't have to answer to the markets, and he doesn't have to answer to the
they're suffering, doesn't have to care.
It doesn't matter, right? So high levels of unemployment.
What is more? We obviously so much more do we use than we export there.
Here's the one thing I would say is that, remember, in democracies, you have your fights out loud and in public. You don't think the knifing, in the back of other people is happening over there. Of course it's happening in there. Right. It just happens behind closed doors, right? And those battles are happening there as well. We're just not privy to what's...
Who can last longer?
Oh, I think we can last longer.
We can.
Yeah, we have a much more
Even though they don't care
economy.
what happens.
We have a much more dynamic economy.
I know, but they don't have to worry about the well-being of the populace. Do they? Not yet.
Until
they're used to
a certain point. Until you do, right? Remember how we turned on a dime when it came to COVID, right? They weren't going to, they had the lockdown, then there were protests, boom, disappeared the next day, right? So,
but they did go through that for a lot longer.
Right.
So what do you think anything happens this weekend? We go to 50.
Oh, I think the message this weekend is that when it comes to the markets, we are now in a period of de-escalation when it comes to trade rather than escalation.
But
right?
are they going to be
in the worst?
Are they going to be eager to get to that point so we can bring things back down?
Oh, I think both sides are eager for de-escalation for sure. The bigger issue, I think, for the United States is what is our goal here? We have national security concerns, and they are connected to trade. How are they going to bring those two issues together without all what we saw happen in April, right?
Yeah. So what the hell are you? Are you a Democrat or a Republican now? Can you?
I am a centrist who believes in free markets and personal liberties, and that should not be dominated by one party. That should be the value of both parties.
What was the name of your book?
There you go.
What was the name of
More
your book?
prosperity, less government.
You know I'm right.
You know I'm right.
Is the sequel You Know I'm Left?
No.
Okay.
No.
Okay.
No.
Michelle, thank you.
That's the podcast for today and for the week. Thank you for listening. Squawk Box is hosted by Joe Kernen, Becky Quick, and Andrew Ross Sorkin, weekday mornings on CNBC starting at 6 Eastern. To get the smartest takes and analysis from our TV show right into your ears, follow Squawk Pod wherever you get your podcasts. On your podcast feed, wherever you're listening now, you'll find great extras like the entire 2025 Berkshire Hathaway meeting in Omaha, Nebraska. Hours of Warren Buffett in his last shareholder meeting as chair. We'll meet you right back here on Monday. In the meantime, have a great weekend and happy Mother's Day.
We are clear. Thanks, guys.